how does the electricity that, charges your phone or the gas warming your home, how does that genuinely shape our collective future? And what happens when a massive company makes these multi-billion-dollar bets on that very energy? Today, we're taking a deep dive into CMS Energy Corp, or just CMS. They're a truly critical player in Michigan's entire energy landscape. We've pulled apart articles, research, financial reports, a lot of our own notes, really, to give you a shortcut, hopefully, to understanding this complex, vital topic. Our mission today is to thoroughly unpack CMS Energy's ambitious plan for Michigan's clean energy transition, grid modernization, all of it. We're going to try and reveal the enormous opportunities, the significant challenges, and what this all means for you, their customers, and, well, the broader energy sector. By the end of this deep dive, you should understand not just what they're investing in, but how they manage these huge financial commitments, navigate a really intricate regulatory environment, and constantly strive to balance, reliability with affordability.
Yeah, just to set the stage quickly for our deep dive, CMS Energy isn't just any utility. It's a Michigan-based energy holding company, and it's almost entirely focused on its main subsidiary, Consumers Energy. And this one utility serves, a staggering 6.8 million of Michigan's 10 million residents. That's huge. The really critical insight here, I think, is that over 95% of its consolidated earnings come from these regulated operations. So that makes it what we call a pure play in Michigan's regulated utility sector, meaning its fortunes are pretty much entirely tied to the state's specific energy policies and, crucially, its regulatory environment. It's a remarkably focused business model. It reduces a lot of the market uncertainties you might find in other sectors.
All right, so if it's a pure play in Michigan, let's unpack that. We really need to jump right into the energy engine room itself, right? Deconstruct CMS Energy's business model to really get the foundations.
Right. So when we talk about CMS Energy, we're basically talking about the core backbone of Michigan's energy system. Through Consumers Energy, it's not just providing a service, it's foundational infrastructure for nearly 70% of the state's population, spanning 68 counties in Michigan's Lower Peninsula. That's a huge footprint. You mentioned it's a pure play investment, which for those of us tracking the sector means its primary focus is squarely on these regulated operations within the state.
Exactly. And understanding this pure play nature is absolutely crucial, because it leads us straight to the fundamental concept of a regulated utility, the rate base. For those maybe less familiar, this is essentially the approved value of the assets, think power plants, pipes, wires that CMS has invested in to serve customers. And on this rate base, they're allowed by regulators to earn a predictable, regulated return. It's the engine of their stable earnings. This mechanism, where they get compensated for building and maintaining essential infrastructure, that's why regulated utilities like CMS typically show such stable earnings and cash flows. Their core business isn't really subject to the wild swings of competitive markets, It's built on long-term infrastructure, predictable compensation. That's key to understanding their whole investment profile.
That distinction is vital. So, okay, let's drill down a bit further into the operations. Look at their core segments. First, we have the electric utility. From what I gathered, this really is the undisputed powerhouse of CMS Energy, isn't it?
It absolutely is, no question. This segment serves 1.9 million customers. It covers major Michigan cities like Grand Rapids, Flint, Kalamazoo, Battle Creek, Saginaw, basically large swaths of the Lower Peninsula. Its operations are really comprehensive, covering a whole life cycle of electricity: generation, buying power from others, transmission across long distances, distribution right down to homes and businesses, and finally selling that electricity to you, the customer. And what's really striking is its strategic importance for CMS's future. The electric business is slated to get about 68%, maybe even a bit more, so around $8.4 billion, of the company's massive $20 billion planned capital investment for the 2025 to 2029 period. Historically, this segment also brings in roughly 70% of Consumers Energy's total revenues. So yeah, it cements its role as the dominant earnings driver and really the critical focus for future growth.
Wow, 68% of that $20 billion just for electric. That is an enormous bet. What's the biggest strategic driver for putting that much capital on the electric side? I mean, beyond just serving customers, is it modernization?
Yeah.
Capacity? Something else?
Well, it's primarily a multifaceted bet, really. It's on modernization and the clean energy transition, alongside needing to meet that surging demand we'll talk about later. A really substantial chunk of that $8.4 billion is specifically for the reliability roadmap.
Ah, okay.
Think grid hardening, replacing aging infrastructure like poles and wires, deploying smart grid tech to handle severe weather better. But it also includes huge investments in new clean energy generation, solar, battery storage. Got to meet Michigan's pretty aggressive decarbonization goals. So yeah, it's about making the grid smarter, tougher, and greener,
Yep.
all at the same time.
Okay, makes sense. Now, beyond the electric side, they also have a very significant gas utility segment, right?
Yeah.
Especially thinking about Michigan's notoriously cold winters, natural gas must be absolutely critical.
Precisely. The gas utility segment serves 1.8 million customers, handles the purchased, transmission, storage, distribution, and sale of natural gas. And its key strategic asset, this is kind of a big deal, is one of the largest natural gas storage systems in the entire U.S. We're talking 15 storage fields, 309 billion cubic feet of capacity.
Wow.
Yeah. And connecting this to the bigger picture, this infrastructure is absolutely critical for reliability during Michigan's peak winter heating season, when demand can just skyrocket. It's not just about the pipes delivering gas day to day, it's about managing that supply for extreme weather, preventing shortages, price spikes. And this segment also gets a very significant chunk of the capital budget, 32%, or about $6.4 billion of that 2025-2029 plan. So that highlights its importance for safety, reliability, modernization, especially replacing old pipelines and cutting methane emissions.
So electric and gas are clearly the behemoths here, the core drivers, but
Right.
there's usually a bit of an outlier, isn't there?
Yeah.
Let's talk about North Star Clean Energy, their non-utility arm. Does it offer maybe a glimpse into a different strategic direction, or is it more just a peripheral thing?
Right, North Star Clean Energy. It used to be called the Enterprises segment. That's the company's non-utility operations. It owns and operates a portfolio of independent power plants, diverse mix, natural gas, wind, solar, biomass, and it markets that power. But while this segment gives CMS some exposure to competitive energy markets, it's important to clarify its contribution to overall earnings is, well, minor. It's certainly not signaling a new strategic direction for the core business. If anything, it really reinforces CMS Energy's identity as a predominantly regulated company. Their focus is firmly on that stable, utility-based business in Michigan. North Star is more of a complement, maybe an interesting side project, than a competitor to their main revenue streams.
Got it. So the core message from all this segment talk really funnels back to the stability of those regulated cash flows.
That's the critical takeaway, absolutely. The whole financial foundation of CMS Energy is built on the high quality and, crucially, the predictability of these cash flows. Customer rates, like we discussed, aren't subject to market whims. They're set through a formal public process with the Michigan Public Service Commission, the MPSC. This regulatory compact, this sort of agreement, ensures the utility can recover its prudently incurred operating expenses and earn that reasonable return on its big capital investments. This mechanism provides exceptional visibility into future earnings, cash generation, which in turn supports their solid investment-grade credit ratings and that remarkable long track record of consistent dividend growth. This predictability is absolutely central to the whole investment thesis for CMS Energy. It's what makes it a utility, not some high-risk tech startup.
That ties it all together beautifully. And with that foundational predictability established, it leads us right into the next critical piece, the regulatory arena. We need to get a handle on how Michigan's MPSC directly shapes CMS Energy's entire growth path. Okay, so since CMS Energy is this pure play in Michigan, the Michigan Public Service Commission, the MPSC, is its all-important regulator. For those less familiar, what exactly is the MPSC and what's its core job?
Right, the MPSC. It's a three-member regulatory body. Its commissioners are appointed by Michigan's governor, and they serve staggered 6-year terms. That staggering provides a degree of consistency, helps insulate it a bit from short-term political winds. Their stated mission is clear and critical: protect the public, make sure energy services across Michigan are safe, reliable, accessible, and this is always the tricky part, reasonably priced. It's a real balancing act, as you can imagine.
And their power must be pretty immense, given that mission, right? They're essentially the gatekeepers for CMS Energy's whole strategy.
Oh, their power is immense, absolutely. The MPSC wields really extensive authority, granted by both state and federal law. They control pretty much every aspect of utility operations for CMS Energy. Setting customer rates, approving those massive capital spending plans like the $20 billion we just talked about, sanctioning long-term resource plans like Consumers Energy's big clean energy plan. And what's particularly insightful here is looking at recent MPSC actions, like increasing bill credits for customers who have prolonged power outages. That signals a heightened direct focus on utility reliability, which aligns perfectly with and honestly provides strong justification for CMS's proposed grid investments. It shows the MPSC isn't just passively reacting to proposals, it's actively shaping the utility's priorities, creating a regulatory environment that demands specific outcomes, like better reliability. Okay, so the MPSC sets the rules, but how does CMS Energy actually get approval for its spending and recover its costs? I know it involves something called rate cases, which they always sound a bit like a legal battle for every single dollar. Rate cases are indeed the lifeblood for a regulated utility. They are these formal legal proceedings where Consumers Energy seeks to recover its operating costs and, crucially, earn that authorized return on its capital investments. And analyzing recent rate cases, say from 2022 up to now, gives us a really clear picture of the MPSC's consistent approach. You could describe it as constructive, generally supportive of investment, but consistently disciplined.
Disciplined.
Yeah, it's a negotiation, sure, but one bound by extensive legal and economic analysis, not just throwing numbers around.
Can you give us a couple of recent examples just to illustrate how these rate cases typically played out? It sounds like there's always a bit of give and take in negotiation.
Absolutely. Let's look at electric rate case U215A5A5. The final order came out in March 2025. Consumers Energy initially asked for a revenue increase of $325 million. They later revised that down to $277 million. But the MPSC's final order authorized an increase of only $176 million. So that's roughly 64% of the revised request. In that case, the MPSC approved an allowed return on equity, or ROE, of 9.9% and set their capital structure with 41.73% common equity. It's a pretty clear example of the haircut, as they call it, that utilities often face. They ask for X, they get Y, and Y is usually less than X.
Right.
Then there's electric rate case U20-70, filed in June 2025. This one's ongoing. Here, the company's seeking a pretty substantial $460 million increase in electric rates. And this request is mainly driven by needing to recover costs for that ambitious reliability roadmap. $177 million for distribution investments, $104 million for related O&M. For this case, they're asking for a slightly higher ROE, 10.25%, and a bit more common equity in the mix, 42.94%. We expect a final order from the MPSC on that one by April 2026. It just underscores this continuous cycle. Invest, justify, request recovery, get less than requested. Repeat.
Looking at these rate cases, it is striking that the MPSC consistently grants less than what's requested. Some might see that as, I don't know, confrontational. Is this common across the utility sector, or is it specific to Michigan's approach? And how does this constructive but disciplined dynamic actually play out for CMS's long-term planning? Does it make them more cautious?
That's the core insight, really. And it's less confrontational, more just a systemic feature of utility regulation in many states, Michigan included. The MPSC's constructive but disciplined approach isn't just about negotiation. By almost never granting the full request, the regulator, maybe paradoxically, enforces this perpetual drive for efficiency.
Right.
It ensures that while the utility can invest, it absolutely must justify every dollar, prevents complacency. It's kind of a built-in mechanism for continuous optimization, often just seen as a haircut. For CMS's long-term planning, it means their projections, their capital requests, they have to be incredibly robust, backed by tons of data and analysis. Because they know they'll always need to defend their spending and expect some level of adjustment. It forces a very rigorous internal process.
So there's always this strategic dance between the utility and the regulator, always adjusting. And speaking of timing, there's a challenge you often hear about in this industry called regulatory lag. Can you explain what that is and why it's particularly tough right now?
Regulatory lag. Yeah, it's not just some accounting headache. It's a real strategic tension. And it's especially impactful in inflationary times like we've seen recently. It basically refers to the delay between when a utility actually spends money on investments in operations and when those costs finally get reflected in the rates customers pay. I mean, imagine trying to run a multi-billion-dollar business where the prices you can charge are based on costs from, say, a year or two ago.
Yeah, that sounds tough.
Especially when inflation is driving up your current costs rapidly. This lag can lead to a temporary squeeze on earned returns because your actual costs are outpacing the projections used in the last rate case. The current U21-870 case we mentioned is a perfect example. The rate set for 2026 will be based on a forecast test year ending way out in April 2027. But the real insight here is how this lag, while it seems like a burden, actually forces utilities like CMS to become incredibly sophisticated in their long-range forecasting. They basically have to operate with one eye firmly on a future that's already costing them money today.
It sounds like a complex but ultimately a well-understood relationship. Now, management clearly talks up Michigan as a top-tier regulatory jurisdiction. But given the consistent haircuts on rate requests, the regulatory lag, is that fully objective? Or is there a bit of, optimistic spin there? What are the counterpoints?
That's a very fair question. And yeah, while management calling Michigan top tier definitely has an element of strategic optimism, you want to signal confidence, right? It's also grounded in some key realities. For CMS, the positives seem to heavily outweigh the challenges. It's really bolstered by Michigan's 2023 energy law. That law set very aggressive clean energy mandates, specifically a 60% renewable portfolio standard by 2035 and a 100% clean energy standard by 2040.
Right, those are big numbers.
Huge. And the critical point is how this legislation provides a durable, long-term policy foundation for CMS's capital investment plans in renewables and grid modernization. It creates this clear alignment between state policy objectives and the utility's core growth strategy that effectively de-risks a significant chunk of their long-term investment. That's a massive plus.
Okay, so policy alignment is key.
Exactly. Now, for the counterpoints. Sure, the consistent MPSC rate case haircuts and the regulatory lag can definitely be frustrating for a utility needing capital for such huge projects. You could argue Michigan's MPSC is maybe more consumer-focused than some other state commissions, potentially leading to slightly lower authorized ROEs than utilities might get elsewhere. That's debatable, but possible. However, for CMS, the clarity of those clean energy mandates and the overall predictability of the process, even with the haircuts, provides the stability they need for massive capital deployment. That's likely the key reason for their top-tier assessment. It's about stability and policy alignment, even if it means constant negotiation on the exact rates.
That alignment between state policy and utility strategy seems incredibly important for a company so tied to its home state. And that brings us perfectly to the broader currents impacting not just Michigan, but the entire U.S. utility sector. Let's dive into segment 3, industry dynamics and macro context. Okay, so CMS Energy operates in Michigan, but it's certainly not in a vacuum. It's affected by what's happening across the wider U.S. utility sector. We've heard a lot lately about a pretty dramatic shift in electricity demand. What's really changing across the industry right now, and why is it such a big deal?
We are absolutely witnessing a true paradigm shift in electricity demand across the U.S. It's a real reversal after about a decade of relatively flat load growth. Utilities are now facing this significant, maybe even unprecedented surge in projected power consumption. And the real paradigm shift isn't just that demand is growing, but the almost breakneck speed at which this inherently slow-moving infrastructure sector now has to adapt. We're basically asking a supertanker to perform like a speedboat, and that's the core challenge. This acceleration is driven by this powerful mix of factors. First, the massive energy needs of new data centers powering AI, just huge loads.
Yeah, hearing a lot about that.
Second, the broad electrification of transportation EVs and buildings, heat pumps, etc., as we shift away from fossil fuels. And third, a bit of a resurgence in domestic manufacturing, often requiring significant dedicated industrial power. So national load growth, which was pretty sluggish for years, is now projected to jump by something like 23.9% between 2021 and 2035. And importantly for CMS, this trend is particularly acute right there in the upper Midwest, placing them smack dab in the center of this new growth era.
Wow, so demand is suddenly going through the roof after years of flatness. What does that mean for how utilities are planning and investing? Are they actually ready for this kind of acceleration?
It means record capital expenditure. Plain and simple. Utilities across the nation are planning unprecedented levels of investment. Forecasts hit $174 billion in 2024 alone. And a huge chunk of this is specifically for upgrading and expanding transmission and distribution systems. Got to meet the surging demand, got to improve reliability, but this investment push is happening amidst this complex energy transition, which brings its own hurdles. Big ones. We're seeing persistent challenges like supply chain disruptions for key components. Transformers are the classic example. Those aren't minor hiccups. They can delay projects by months, even years.
Right, those transformer shortages were big news.
Yeah. Then there's ongoing inflation driving up costs for everything, labor, materials, and these long interconnection queues for new clean energy projects trying to get hooked up to the grid, literally waiting years just for grid access. So it raises the big question, how quickly can the system really adapt when it's facing these complex interconnected challenges? And what's worth highlighting here is that to ensure grid reliability amidst this rising demand and the on-again, off-again nature of renewables, many utilities, CMS included, are proposing new natural gas-fired generation. They see it as a critical bridging and backup resource. It's not a complete shift away from fossil fuels yet, but more a strategic integration to maintain stability during the transition.
Okay, so it's a mix of old and new tech to keep things running, but with significant headwinds like supply chains and costs. Beyond the industry's internal dynamics, how are federal policies impacting all this? We've heard a lot about the Infrastructure Investment and Jobs Act, IIJA, and the Inflation Reduction Act, IRA. Are they delivering real tailwinds, or is it maybe more complicated?
No, these federal policies are absolutely providing significant tailwinds for utility capital investment. They're pretty transformative, actually. The Infrastructure Investment and Jobs Act, the IIJA, passed in late 2021. It allocates billions, literally billions, in federal funding and grants that utilities can apply for. For example, there's $5 billion specifically for enhancing electrical grid resilience, $2.5 billion for upgrading transmission lines, $7.5 billion to build out a national EV charging network. These programs offer a direct financial boost for utilities like CMS to accelerate investments in grid modernization, electrification. It aligns federal money with state and corporate goals, basically means lower capital costs for projects, which hopefully translates to less pressure on customer rates down the line.
And what about the Inflation Reduction Act, the IRA? That sounded like a genuine game changer for clean energy economics. How deep is its impact proving to be?
It truly has been a game changer. The IRA, enacted in early 2022, offers this comprehensive suite of tax credits and incentives, and they significantly improve the economics of renewable energy projects. By lowering the effective cost of wind, solar, battery storage, the IRA makes the clean energy transition more affordable for customers and, critically, more financially viable for the utilities building it. For CMS, these credits can directly reduce the cost of building those new solar farms or battery storage facilities they need. Makes their ambitious clean energy targets more achievable without hitting ratepayers quite so hard. And what's also key here is the strong bipartisan and industry support for many of these provisions. That suggests a high degree of durability.
Ah, that's important.
Yeah, it means these incentives are likely to be a long-term fixture, providing ongoing support for their clean energy plans and a predictable environment for investment. That predictability is gold for utilities planning decades ahead.
So, a lot of big picture tailwinds from federal policy, which sounds great, but there's always this silent driver lurking in the background for utilities, and that's interest rates. Why is the utility sector uniquely sensitive to them? It feels like rates affect every sector, but you're saying it's particularly acute here. Why?
Yeah, the utility sector is indeed uniquely sensitive to interest rates. It hits them in two main interconnected ways. First, there's the bond substitute effect. Utility stocks, because of their stable earnings and reliable dividends, are often seen by income-focused investors as alternatives to bonds.
So, when interest rates and bond yields rise, the relative attractiveness of those utility dividends can diminish. Why take equity risk if you can get a similar yield from a safer government bond? That can put downward pressure on utility stock valuations. Second, and perhaps even more critically for their actual operations, utilities are incredibly capital-intensive businesses. Huge infrastructure needs. They rely heavily on debt to finance these massive long-term projects. A higher interest rate environment directly increases their cost of borrowing. That hits their bottom line. Now, while these higher financing costs should eventually be recovered through customer rates, if there's a delay in that recovery, that regulatory lag we talked about, or if the MPSC disallows a portion, it can temporarily compress their earnings. So the sharp rise in rates from 2022 into 2024 was definitely a notable headwind for the sector, made capital much more expensive. However, looking forward, a potential stabilization or even a decline in rates could quickly become a tailwind. Could boost valuations, lower financing costs. It shifts the dynamic significantly. It's this constant tightrope walk between securing capital and managing its cost.
It's all connected, isn't it? That sensitivity to interest rates, combined with the other industry dynamics, regulatory pressures, it all leads us right to segment 4, the financial pulse. How is CMS Energy's performance and financial health actually holding up amid all these swirling currents?
Okay, so given all these macro factors, regulatory pressures, how has CMS Energy actually been performing financially? The source material highlights a pretty remarkable achievement, 22 consecutive years of meeting their adjusted EPS guidance. That sounds incredibly consistent, almost too perfect.
It is an exceptional track record, no doubt about it. It's really a testament to the predictability of their regulated business model and, frankly, the strong operational skill of their management team. Meeting adjusted EPS guidance for 22 years straight is incredibly rare in any industry. It shows their ability to navigate that regulatory environment and execute their plans consistently, year after year. It really speaks to a very disciplined forecasting and execution process within the company. But when we look at their revenues, they seem to show only, well, modest growth, like $7.46 billion in 2023, up to $7.52 billion in 2024. Pretty flat. How does that modest top-line growth square with such strong, consistent EPS growth? It almost seems contradictory at first glance.
That's a great observation, and it really highlights a key difference for regulated utilities compared to, say, a tech company. For a company like CMS, the primary driver of value isn't necessarily explosive top-line revenue growth. The core value driver is actually the growth in adjusted earnings per share, or adjusted EPS. CMS, like many in the sector, emphasizes this adjusted EPS. It's their non-GAAP measure. As you know, this strips out the noise of non-recurring items, things that can distort the picture of ongoing operations.
Right, gives a clearer view.
Exactly. Gives us a cleaner apple-to-apples view of their underlying regulated profitability. For instance, in 2023, their adjusted EPS of $3.11 excluded costs from a voluntary separation program. That gives a better picture of the profitability tied directly to their rate-based investments.
Okay, so what does that adjusted EPS progression look like year over year? And how directly does it tie back to their core strategy?
It's been very steady, consistently upward. Let's see. In 2022, reported EPS was $2.85, adjusted was $2.89. By 2023, reported grew to $3.01, and adjusted EPS increased to $3.11. And in 2024, reported EPS at $3.33, with adjusted EPS at $3.34. This consistent year-over-year growth in adjusted EPS is the direct result of their core strategy. Invest prudently in that rate base, and then secure constructive regulatory treatment from the MPSC to earn a reasonable return on those investments. It's a very deliberate and so far very successful algorithm. Deploy capital, grow rate base, grow earnings. It directly translates capital deployment into shareholder value.
Okay, so with all this investment happening, their balance sheet must be growing significantly too. How's their credit profile holding up with all this activity? Maintaining those investment-grade ratings must be absolutely paramount for them, non-negotiable probably.
You're absolutely right. The balance sheet expands directly in lockstep with their capital program. It has to. For instance, their total debt and finance leases, excluding some specific securitization debt, grew from $14.86 billion at the end of 2023 to $15.87 billion by the end of 2024. That reflects the necessary new borrowing to fund those massive infrastructure projects. But at the same time, common stockholders' equity also increased from $7.32 billion to $8.01 billion. That shows a balanced approach to financing, which is crucial for maintaining a stable capital structure. We're not just loading up on debt. And what's absolutely non-negotiable for CMS, as you said, is maintaining a solid investment-grade credit profile. They target ratings like Band 2 from Moody's, BBB from S&P. These ratings are vital. They ensure CMS can access the capital markets at reasonable costs, which is fundamental for a utility needing billions in funding every single year. A downgrade would directly increase their cost of capital. That could threaten their earnings growth targets, put upward pressure on customer rates. That's a line they absolutely cannot cross.
Makes perfect sense. So they're taking on debt, yes, but it's for investment in the rate base, and they're managing it carefully to keep good credit ratings. How does this translate into their cash flow dynamics? For those less familiar with utility financials, this often looks quite different from a typical company, right?
It is indeed quite distinct.
Right.
Looking at CMS Energy's cash flow statements really illustrates the nature of a utility in a heavy investment cycle. Net cash from operating activities, the cash generated from the core business, has been consistently robust and stable. Came in at $2.31 billion in 2023, $2.37 billion in 2024. That consistency is a hallmark of high-quality earnings from the predictable, regulated utility business. However, and this is key, this strong operating cash flow is intentionally more than offset by the cash used in investing activities, which is overwhelmingly dominated by capital expenditures, CapEx.
Right, all that building.
Yes, exactly. Net cash used in investing activities was a huge $3.39 billion in 2023 and $3.05 billion in 2024. So this results in negative free cash flow. Operating cash flow minus CapEx is negative. But it's absolutely crucial to understand this is not a sign of financial distress for a utility like this. It's actually normal and expected for a utility aggressively expanding its rate base.
Okay, that's a critical distinction.
Yeah. This funding gap, the negative free cash flow, is systematically closed through issuing new debt and equity. You see that on the financing section of the cash flow statement. It clearly shows the capital-intensive nature of the business and how capital markets are essential partners in their growth.
Okay, got it. Negative free cash flow isn't necessarily a red flag here. And finally, let's talk dividends, often a cornerstone for utility investors. How sustainable is CMS Energy's dividend policy, especially with all this capital spending going on?
The dividend is absolutely a cornerstone of their value proposition to investors. No question. CMS has a strong, reliable track record here. They announced an increase to their annual dividend for 19 consecutive years as of their February 2025 announcement. That's consistency. For example, the annual dividend went up to $2.17 for 2025 from $2.06 in 2024. The sustainability of this dividend is supported by their formal policy, which targets a payout ratio of roughly 60% of adjusted earnings over the long term.
Okay, 60% payout.
Yeah, which is pretty prudent for a regulated utility. It's high enough to give a meaningful return to shareholders, but conservative enough to let them keep significant capital for reinvestment in the business. Its sustainability is fundamentally tied to that predictable earnings growth we talked about. As long as CMS successfully executes its capital plan and gets constructive outcomes from the MPSC, that earnings base should keep growing. That allows for commensurate growth in the dividend while keeping that target payout ratio. It's meant to be a virtuous cycle.
That paints a very clear picture of their financial health and strategy. And all this investment and growth leads us perfectly into the core of their future vision. Building tomorrow's grid. Let's look at CMS Energy's strategy, their investment plans, and how they're actually executing it all on the ground. So we've talked about the impressive financial picture, and it's all driven by this massive capital investment program. Let's really get into the details of this $20 billion growth engine for the 2025 to 2029 period. That is just a staggering sum, represents a huge commitment for one state.
It is indeed a monumental undertaking. It's the largest capital plan in the company's history by far. CMS has outlined this plan to invest a total of $20 billion over that 5-year window. And importantly, this represents a $3 billion increase from their prior 5-year plan. So it signals a significant acceleration of their investment activities. This kind of scale really underscores their commitment to transforming Michigan's energy infrastructure and, meeting the state's ambitious clean energy goals we discussed.
And how is this capital being strategically allocated? Where's all that money actually going, and what's the logic behind splitting it up that way?
The allocation clearly reflects their strategic priorities. It directly addresses the challenges and opportunities we've been talking about. The largest single share, $8.4 billion or 42%, is earmarked for electric distribution and other initiatives. This is largely funding their reliability roadmap. Think grid hardening, replacing 20,000 poles annually, burying 400 miles of power lines each year. That's a lot of digging.
Yeah, it is.
And deploying smart grid technologies like automatic transfer reclosers, ATRs. Those help isolate faults faster, reduce outage times. These are tangible, impactful investments aimed right at improving your daily experience with electricity. Fewer, shorter outages, hopefully. Then another substantial portion, $5.2 billion or 26%, is dedicated to clean energy generation. This focuses on solar and wind development, battery storage crucial for meeting those state clean energy standards. We're talking really ambitious targets like 8,000 megawatts of solar and 550 megawatts of battery storage by 2040. And projects like the 360 megawatt Sunfish Solar 2 facility are already breaking ground. So this isn't just on paper, shovels are in the ground.
Right.
Finally, the gas utility segment gets $6.4 billion, or 32%. That's for replacing old pipes through their Enhanced Infrastructure Replacement Program, EIP, system modernization, safety upgrades, and critically reducing methane emissions to hit that 2030 net zero methane goal.
Okay, so it's not just throwing money around, it's strategic targeted investments across the board. The why of this investment, as you mentioned, is driving that rate-based growth, fueling the 6-8% long-term adjusted EPS growth target. But let's zoom in on that clean energy transition piece. CMS Energy has an incredibly aggressive coal exit plan, right? That seems like a major pivot.
They really do. CMS is on track to become one of the first major utilities in the U.S. to operate entirely without coal-fired generation.
Yeah.
That's a big deal. Their landmark plan calls for retiring their final 3 coal units at the J.H. Campbell plant in 2025. That's next year. This is a huge strategic move. It completely redefines their generation portfolio and positions them as a real leader in decarbonization among large U.S. utilities.
And to replace that coal capacity, they're going all in on renewables, basically. That's an ambitious shift, especially given Michigan's climate, lots of clouds, snow.
Absolutely. To replace that retiring coal and meet Michigan's mandates, their long-term plan includes adding nearly 8,000 megawatts of solar generation and 550 megawatts of battery storage by 2040. It's a massive shift and a direct alignment with the state's 60% renewable portfolio standard by 2035 and that 100% clean energy standard by 2040. But what's worth highlighting here is that while this is an aggressive renewables push, they're also being pragmatic. They're using natural gas as a critical bridge fuel. Their 2021 resource plan included the strategic acquisition of the Covert Generating Station. That's a modern 1.2 gigawatt natural gas plant. This asset provides essential, dispatchable power, meaning they can turn it on when needed to back up those intermittent renewables like solar and wind. ensures grid reliability during this massive transition. It's a practical approach to a huge engineering challenge. You can't just flip a switch to 100% renewables overnight.
Right, you need that backup. So it's not just about generation, it's also about modernizing the grid itself and the gas infrastructure to handle all these changes and meet rising demand. You mentioned the reliability roadmap earlier. What does that actually mean for the average customer? What should they expect to see or feel?
That's right. The reliability roadmap isn't just some corporate slogan. It's about concrete actions on the ground aimed directly at you, the customer. Its goals are customer-centric. Significantly cut the frequency and duration of power outages. They're aiming for no single weather event to knock out power to more than 100,000 customers. And they want to restore power to all affected customers within 24 hours of an outage. Those are ambitious targets.
Very ambitious.
Yeah, and concrete examples include burying up to 400 miles of power lines annually, replacing 20,000 utility poles each year, those old wooden ones, and deploying advanced smart grid tech like those ATRs we mentioned, which help pinpoint and isolate faults much faster. I mean, we've all been there, right? That frustrating moment when the power goes out, especially during a Michigan ice storm. The idea of burying 400 miles of lines a year, there's not just infrastructure. That's potential peace of mind for a lot of people who've maybe spent a few too many evenings by flashlight. And in parallel, the gas utility is systematically upgrading its system through that EIRP program, replacing decades-old pipes. That improves safety and significantly cuts methane leaks, helping meet that 2030 net zero methane goal.
That's a lot of moving parts, very specific goals. And the period from 2022 to 2024 saw some major developments, but also undoubtedly some significant operational challenges too, didn't it?
Absolutely. A real landmark achievement was the MPSC's approval back in June 2022 of Consumers Energy's updated Clean Energy Plan. That was a critical de-risking event. It basically codified the company's aggressive coal exit, the covert gas plant acquisition, and the massive solar build-out, all within a clear regulatory framework, provided certainty for their investments. Then in a really significant strategic development, July 2025, CMS announced an agreement to serve a new large-scale data center.
Ah, the data center, yeah.
This is a potential inflection point. It's expected to add up to 1 gigawatt of new electric load to their system. That's huge. What's crucial here is that this represents a significant acceleration of demand growth. It provides strong justification for future generation and grid investments. Basically says, see, we need this capacity. More recently, September 2025, Consumers Energy also agreed to sell its 13 hydroelectric dams, a move intended to reduce long-term costs for customers by divesting assets that were maybe less strategic in their future, cleaner portfolio.
That new data center sounds like a huge boost, accelerating demand, but it probably brings challenges too, I imagine. And we've definitely seen an increase in extreme weather events, which must be a recurring headache for their operations. I remember that massive ice storm back in 23. The community impact was just profound. Are these infrastructure improvements actually making a noticeable difference on the ground yet for everyday Michiganders?
Indeed. Management explicitly called 2023 a challenging year, citing unfavorable weather and significant storms. These events directly test the grid's resilience. They lead to widespread outages, big restoration costs, and immense frustration for customers. In response, CMS has made grid hardening a central pillar of its strategy directly through that reliability roadmap. And yes, they are reporting tangible progress. In 2024, they said they reduced the average customer power outage duration by 21 minutes compared to the prior year.
Okay, that's something.
Yeah, and they restored power to over 93% of customers in less than 24 hours, up from 87% in 2023. These efforts involved completing over 1,350 major upgrade projects, clearing trees and branches along 7,000 miles of power lines, which is just an ongoing battle in a state like Michigan with so many trees.
Constant battle.
Right, and an underground power line pilot program has also reportedly proven highly effective against recent severe weather. Offers a glimpse into maybe more undergrounding in the future. So yes, the efforts seem to be tangibly improving reliability, even as the weather itself seems to be getting more intense.
Okay, so they're actively fighting the weather battle. But what about inflation and those supply chain headwinds? Those have been hitting everyone. But for a company starting a $20 billion capital plan, those extra costs must be enormous, potentially derailing things.
Yeah, like the broader utility industry, CMS has definitely faced these macroeconomic headwinds. They have the potential to significantly increase cost and delay their large-scale capital projects. I mean, for a plan of this magnitude, even seemingly small percentage increases in material or labor costs can translate into hundreds of millions of dollars. It adds up fast. In response, management has emphasized proactive supply chain strategies. They note about 90% of their supply chain is sourced domestically.
Okay, that helps.
It helps mitigate some geopolitical and logistical risks, reduces reliance on global bottlenecks, but they're not entirely immune, of course. They also rely heavily on their internal CE Way lean operating system to try and drive cost savings. In 2023, they reported achieving $79 million in O&M savings and $172 million in capital cost savings through this initiative. But it raises an important question. How much more efficiency can they squeeze out before it starts impacting service or future investment capacity? There's always a limit. And just recently, May 2025, they announced a new organizational structure designed to better support their long-term strategy with clear leadership for key business units. Shows they're adapting organizationally to these operational challenges.
It sounds like they're tackling these challenges head-on with a very structured, maybe even data-driven approach. All of this brings us neatly to our final segment, the competitive edge, the roadblocks, and the value proposition. Let's look at the bigger picture for CMS Energy. All right, so when we talk about CMS Energy, are they really competing with anyone in Michigan in the traditional sense? It sounds like they have more of a functional monopoly for energy delivery across vast parts of the state.
That's essentially correct. Within Michigan, the investor-owned utility market is effectively a duopoly. You have CMS Energy's subsidiary, Consumers Energy, and then you have DTE Energy. And crucially, they operate in largely distinct and non-overlapping service territories. So yeah, each has a functional monopoly for regulated energy delivery within their respective areas. DTE covers Southeast Michigan, including Detroit. Consumers Energy covers the majority of the rest of the Lower Peninsula. Now, what's important here is that while customers can choose alternative electric or gas suppliers for the actual energy commodity that's a competitive market piece, the incumbent utility, whether it's CMS or DTE, still owns and operates the transmission and distribution infrastructure.
The pipes and wires.
Exactly, the pipes and wires that bring the energy to your home or business. Their core delivery business remains a functional monopoly.
Okay, so if they're not really competing for customers in the usual way, where does the true competition actually lie? Is it just about who can build the most efficient grid, or?
The true competition, I'd argue, is for regulatory and political capital, primarily at the MPSC. Both CMS and DTE have to present their rate requests, their investment plans, to the same regulator. And the MPSC's decisions on one utility can definitely create precedents or influence the regulatory climate for the other, especially on statewide issues like affordability, reliability standards, clean energy policy. So it's maybe more of a regulatory chess match than a market brawl, where effective lobbying, strong data, a compelling narrative are paramount. And on the operational efficiency front, CMS points to its CE Way lean operating system. Those savings, they reported $79 million O&M, $172 million capital in 2023. That's presented as a key internal competitive advantage. It helps manage costs, which ultimately impacts customer bills, and importantly, bolsters their case before the MPSC. They're effectively competing on who can deliver the best value and reliability within that regulated framework.
That makes perfect sense. A different kind of competition. Now let's talk risks. With a $20 billion capital plan, this aggressive clean energy transition, all these broader industry changes, what are the most significant roadblocks or potential pitfalls for CMS Energy? What could go wrong?
The single greatest risk facing CMS Energy, hands down, is regulatory risk, simply because nearly all of its earnings are subject to that MPSC oversight. Any adverse shift in that environment could materially impact their financial results. The most obvious aspect is unfavorable rate case outcomes. Where the MPSC authorizes less than they request, we've seen this consistent pattern. They rarely grant the full amount. That could mean lower revenues, a lower ROE, maybe an unfavorable capital structure decision. Then there are prudence reviews. With a massive $20 billion plan, there's always a risk the MPSC could deem certain costs imprudently incurred after the fact and disallow them from being included in the rate base. That would hurt. Yeah. What's truly fascinating here is just imagining how much careful planning must go into justifying every single dollar, every pole replacement, every smart grid device, just to try and preempt those kinds of challenges. And finally, while current Michigan energy law is supportive, future legislative changes, maybe a different governor with different priorities, could alter policies and disrupt their long-term strategy. Despite the current positive alignment, policy can always change.
Okay, so regulatory oversight is paramount. What about the environmental and operational risks, especially given the increasing severity of weather we just discussed?
Those are also significant and frankly growing. The increasing frequency and intensity of severe weather, those ice storms, tornadoes, heat waves, pose a direct physical threat to CMS's infrastructure. These events cause widespread outages, damage expensive equipment, lead to substantial restoration costs. Management acknowledged this reality regarding 2023. There's also just the inherent risk of aging infrastructure. Despite the reliability roadmap and the gas pipe replacements, operating such a vast aging network means critical components can still fail, causing localized outages or safety hazards. And of course, cybersecurity. The threat is growing dramatically. As the grid gets more digitized, more smart devices connected, relying on complex IT systems, it becomes a more attractive target for sophisticated attacks.
Right.
Attacks that could disrupt operations or compromise sensitive customer data. The board gets regular updates on this, highlighting how seriously they take this evolving risk. It's almost like they're playing defense against both Mother Nature and increasingly sophisticated digital adversaries.
Beyond operations, what are the key financial and market risks they face, especially given how capital-intensive this business is?
Well, as we discussed earlier, interest rate exposure is a big one. As a capital-intensive company needing billions in debt, higher rates directly increase borrowing costs. That can pressure earnings if those costs aren't fully and quickly recovered in rates. Inflation and supply chain disruptions also continue to be risks, driving up costs for labor, materials, equipment, potentially causing projects to exceed budgets or face delays. While CMS emphasizes domestic sourcing, they're not immune to these broad industry pressures. These cost escalations can be a significant headwind, especially when combined with that regulatory lag.
And finally, there are always strategic and execution risks with such a huge, complex plan. It's one thing to have a $20 billion plan on paper, quite another to pull it off smoothly.
Absolutely. The sheer scale of the $20 billion capital plan introduces significant execution risk. Managing literally thousands of projects, from huge solar farms down to localized distribution upgrades on time, within budget, that's a major operational challenge for any organization. There's also technology risk. Relying on newer clean energy technologies like utility-scale battery storage or advanced grid control systems introduces potential unforeseen challenges or maybe underperformance as they scale up.
Yeah, will the tech work as planned at scale?
Exactly. How quickly can these technologies mature and integrate seamlessly into a legacy grid? That's a key question. And lastly, that new 1 gigawatt data center load we talked about. While it's a huge opportunity, it also introduces a new element of customer concentration risk. An adverse change in this single, very large customer's plan, say, delayed construction, or even a decision to locate elsewhere eventually could have a disproportionate impact on future load forecasts and investment plans. Creates a new kind of vulnerability they didn't have before.
So a lot of moving parts, significant risks to manage, but also a clear strategy for growth. How does the market value all of this? What's the price tag look like on CMS Energy from an investor's perspective?
Right. When valuing a regulated utility like CMS, we typically look at metrics that reflect its asset-intensive nature and its role as often an income-oriented investment. The forward price to earnings, or PE ratio for CMS Energy, is running around 19.3x currently. Now, that's broadly in line with the utility sector average, but it does represent a bit of a premium compared to some of its larger Midwest peers, like American Electric Power, AEP, which trades closer to 15.8x.
Okay, so a bit of a premium. Why?
That premium likely reflects the market's confidence in the high visibility and perceived certainty of CMS's 6% to 8% long-term EPS growth target. Investors are paying for that predictability. The price to book, or PB ratio, is around 2.6. Being above 1.0 indicates the market values the company's ability to earn returns on its assets at a rate higher than its cost of capital. That's positive. And the enterprise value to EBITDA, or EBITDA, is approximately 13.1x. That's a useful metric for capital-intensive companies because it includes debt in the valuation picture.
And what about the dividend yield for those income investors who are often particularly drawn to utilities?
CMS Energy's forward dividend yield is currently around 3.05%, but that's competitive within the sector. And in the current interest rate environment, it does offer a premium over the yield on, say, the 10-year U.S. Treasury bond. It is, however, slightly lower than the yield offered by some peers, like AEP again, which is closer to 3.4%. And that modest yield differential, again, probably reflects the market pricing in a slightly higher and perhaps more certain growth trajectory for CMS, rather than viewing it as just a pure income play. They expect growth too.
Okay, so it seems like the market is really buying into their growth story and recognizing that underlying stability. What does that mean for the overall valuation relative to their growth prospects? Does it look fair, cheap, expensive?
The company's valuation really appears to be a direct function of that highly visible, regulatorily supported growth plan. That 6% to 8% long-term adjusted EPS growth target is genuinely one of the more attractive and clearly defined growth profiles you'll find in the utility sector right now. Investors seem willing to pay that modest valuation premium for the certainty that comes with it, given the lower perceived risk profile compared to other industries. Now, if you look at something like the price earnings to growth, or PEG, ratio roughly 2.75 using a 19.3x PE, and the midpoint 7% growth, that would be considered high for a company in a more cyclical industry.
Right.
But it's not necessarily uncommon for a stable, predictable utility where the G part to the growth is perceived to have a much lower risk attached to it. So the current valuation suggests the market is largely pricing in the successful execution of the company's strategic plan. But it also implies that successful execution is pretty much a requirement to maintain that premium valuation they have to deliver.
Okay. So, having dissected CMS Energy from pretty much every angle, let's try and distill it down. What's the most compelling argument for an investor to be bullish here? And conversely, what's the really critical concern that would make someone bearish?
The bullish case for CMS Energy really hinges on a powerful and predictable growth algorithm. It's
What?
quite clear. You have this clearly defined, regulatorily supported $20 billion capital investment plan. That's driving 6% to 8% annual adjusted EPS growth. Pretty solid. This growth is directly aligned with durable, long-term trends, decarbonization, electrification. And now it's further supported by a significant new source of demand from that large data center customer. Adds another layer of growth. This high degree of earnings visibility, combined with a secure and growing dividend, and operating within a generally constructive, albeit disciplined, regulatory environment, it presents a compelling investment profile, especially for those seeking stable growth and income. It's a well-laid plan with strong policy tailwinds.
Okay, that's the bull case. Clear growth path.
Right. However, the bearish case doesn't really dispute the strategic plan itself. It focuses more on the considerable risks surrounding its execution. That $20 billion capital plan is the largest in their history, and it has to be executed in this challenging environment. Supply chain issues, inflation, tight labor market. Any significant cost overruns or delays could absolutely lead to MPSC disallowances, potentially threatening that targeted earnings growth rate. Furthermore, the company's exclusive focus on Michigan concentrates its risk. Unlike a geographically diversified utility, any negative shift in Michigan's specific political or regulatory climate would have an outsized impact on their entire business.
Right, all eggs in one basket, state-wise.
Pretty much. And finally, the increasing severity of weather events poses that persistent operational and financial threat. It could require even greater capital spending on grid resilience in the future than currently planned, potentially putting more pressure on customer bills. And this raises that important, maybe uncomfortable question: how much can customers ultimately afford before there's a political backlash that impacts the whole regulatory compact? There's a limit somewhere. Hashtag tag 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 outro end awful.
So, to bring it all back home, CMS Energy is a truly fascinating case study, isn't it? It's a regulated utility with this robust, regulatorily supported growth plan centered squarely on Michigan's clean energy transition and ambitious grid modernization. Their financial strength, that consistent performance track record, management's proactive responses to challenges, those are all undeniably key strengths. But as we've really dug into, significant execution and regulatory risks definitely remain. It makes it a pretty nuanced picture, not just a simple story.
And what really stands out to me is how a company's local operations, especially a utility like this, can have such far-reaching implications for everything from technology adoption to state-level climate policy, even national energy trends. It's not just about keeping the lights on anymore, is it?
Exactly. It's much bigger than that now. And for you, our listener, here's maybe a final provocative thought to chew on. As companies like CMS Energy invest these billions to reshape our energy future and demand for electricity surges in ways we didn't fully anticipate even a few years ago, how much are we as consumers, as citizens, truly willing to pay for both the clean energy transition and the enhanced grid reliability demanded by a changing climate? It costs money. Where do you personally draw the line between necessary long-term investment for the future and the immediate real concern of bill affordability today? And what role do you think policy ultimately plays or should play in balancing these often competing needs as we look ahead?
Yeah, those are not simple questions at all. And they certainly don't have easy answers. But they are pretty essential things to ponder as our entire energy landscape transforms around us.
Absolutely. We definitely encourage you to reflect on how these dynamics might play out in your own community or how they connect to the broader energy sector shifts we're seeing everywhere. Stay curious and keep digging into the details that shape our world. We'll see you next time on The Deep Dive.